Sunday, February 8th, New York. Silver prices had just fallen sharply, yet inside a small bullion shop, the phone kept ringing and the counter was packed with people asking to buy physical silver. The shop owner repeated the same sentence over and over. The premium is too high. This was not rumor, not speculation, not a chart-based narrative. It was immediate reality following the price collapse. The question, then, is not simply about silver prices. What is truly under strain? Silver itself, the US dollar, or the way markets function when paper instruments and physical metal begin to diverge? The moment you step into the shop, you sense the market's rhythm before you even look at the price board. The doorbell rings continuously, not hurried but unrelenting. One customer leaves, another steps forward. No raised voices, no laughter. This is not bargain hunting behavior, nor is it panic selling. It is the distinctive tension that follows a market shock. The price board behind the counter keeps flashing. The numbers move, but no one's eyes follow them for long. Attention remains fixed on the silver trays behind the glass. What stands out immediately is that the first question is not, "What's the price?" but, "Do you still have this?" In normal conditions, that question is secondary. In moments like this, it becomes central. Behind the counter, the shop owner flips through invoices with one hand while adjusting a silver tray that has been nudged out of place with the other. When asked why premiums remain elevated despite falling spot prices, he offers no long explanation. He says only, calmly and without emotion, "I'm not sure I can replace this inventory tomorrow at today's price." The statement hangs in the air, heavier than any chart or indicator. This is where the difference between observing the market and interacting with it becomes clear. On a screen, price is an abstract number. In the shop, price represents a decision with consequences. Selling is not merely a transaction. It is a commitment to restock under uncertainty. A man standing to the left of the counter scrolls rapidly through his phone. He does not address the shop owner, but the person beside him. "If I buy today and the price drops again tomorrow, then what?" The other man pauses. He looks at the silver tray, then the price board, and replies quietly, "If you're afraid of that, you'll always be afraid." There is no argument, no attempt to persuade, but the room is quietly divided into two camps: those seeking absolute certainty and those who accept that markets never provide it. The discussion drifts toward the gold-silver ratio. Someone points out that the ratio is elevated. Another nods, but without enthusiasm. In this room, the ratio is no longer an abstract metric. It must pass through a very concrete filter. At current premium levels, does the conversion still make practical sense? This is where much online analysis tends to stop. The physical market does not allow such simplification. The phone behind the counter rings again. The shop owner answers, listens briefly, then shakes his head. "Not in yet. Probably have to wait." He hangs up and resumes serving customers. No explanation is needed. Everyone understands. The supply chain is slowing, not because silver has vanished, but because participants are reassessing risk. The atmosphere in the shop settles into a very specific tempo. No one rushes, yet no one relaxes. Each decision takes longer than usual, as if everyone is weighing an additional, invisible variable. That variable is simple but powerful. Could tomorrow be worse? It does not appear on the price board, but it governs behavior. An older man stands slightly back, not pushing forward. When his turn comes, he states only the quantity, no questions about price. The shop owner quotes it. The man nods. No bargaining. No hesitation. When asked why he doesn't wait, he replies softly, "I buy by rhythm, not by day." The remark draws little immediate attention, yet it lingers in the minds of those who hear it. This is precisely where the physical market diverges from the paper market. In paper markets, timing is everything. In physical markets, the process is what matters. When volatility increases, these two logics collide. Several familiar products are no longer available. When asked, the shop owner replies simply, "Sold out." No promise of restocking, no suggested substitutes. In moments like this, that silence communicates more than any marketing pitch. It signals a market in a holding pattern, not permanent shortage, but a temporary pause in circulation. Interestingly, items that are not strictly standard bullion attract increased attention. Pieces with distinctive shapes, histories, and identities. As uncertainty rises, people do not seek economic value alone. They seek something tangible, something that can be emotionally anchored. This is not impulsive behavior, but a recurring psychological response observed in many periods of historical instability. Eventually, the conversation turns to the idea of the paper market. There are no accusations, no blame, only a lingering question. Why does the screen price fall so rapidly while conditions here feel increasingly tight? The answer lies not in conspiracy, but in structure. Paper markets absorb shocks first because they are designed to do so. Physical markets absorb more slowly, but once tension builds, it persists longer. The gap between the two markets becomes unmistakable. Not everyone can articulate it, but everyone senses it. The shop owner notes that he once updated prices only a few times per day. Now, turning his back for a few minutes is enough for the number to change. This shift is not merely technical, it reshapes how decisions are made. A customer chuckles when the shop owner has to revise a quote because a board has just moved again. No one complains. Everyone understands that this is the cost of operating in a high-noise environment. And in such conditions, no participant holds a definitive advantage. The question of the bottom arises again, but without excitement. It is asked out of habit, not expectation. When the shop owner says prices could still go lower, there is no strong reaction, no sighs. No one walks away. This moment is critical. It shows that those still present have accepted uncertainty as part of the framework. As time passes, the shop's rhythm becomes clearer. People enter, people leave. There is no surge, but no lull. This is not a frenzy, nor a liquidation. It is accumulation under tension. And that behavior is the signal that matters most. The discussion broadens to larger themes: cost of living, public debt, monetary policy. Voices remain calm. No one argues. These topics function as background context, not driving immediate decisions, but shaping long-term perception. Within this frame, silver and gold are not discussed as vehicles for quick profit, but as components of a defensive strategy. Someone quietly remarks that conditions may worsen before improving. No one disagrees, but no one panics either. Those who remain understand that markets do not offer clear answers. They are not searching for certainty. They are searching for alignment with their own plans. If you stand in the shop long enough, one realization becomes unavoidable. The price board is no longer the center of the story. Behavior is. Who buys? Who waits? Who leaves? And, most importantly, why? This is what charts cannot capture, yet it determines the market's true rhythm. When a customer leaves because someone is waiting at home, the counter breaks into light laughter. The market is tense, but life continues. That intersection makes the moment real. No dramatization, no judgment. Just a cross-section of the market under sufficient pressure to reveal its underlying nature. If you are still watching at this point, chances are you are facing a decision of your own, even if you are not standing in this shop. The question is not where prices will go tomorrow. The question is, when the market enters a high-tension zone, how will you respond? By watching prices or by observing behavior? The scene inside the shop offers no answers. It simply places you in the correct position to think independently. That, ultimately, is the value of observing markets in real space rather than solely through a screen. This is precisely why the moment inside that bullion shop matters more than any chart. It demonstrates that when real pressure emerges, markets respond not through words, but through behavior. The tension is not in today's silver price. It lies in how the financial system is absorbing uncertainty within a political and economic cycle defined by multiple interacting variables. Throughout monetary history, every period of fiscal expansion, monetary adjustment, or power realignment has raised the same fundamental question: how can purchasing power be preserved over time? Gold and silver do not answer with promises. They answer through a role tested across centuries, a stabilizing reference point when confidence in fiat currency is challenged. And this may only be the beginning. Future adjustments in policy, extraction technology, industrial demand, and global capital flows will unfold not over days, but over quarters and years. We will continue to track each phase of that movement. Do you believe the tension between paper markets and physical markets will continue to widen or gradually converge in the next cycle? Share your perspective. This is Money Cycles, where we examine the structural forces beneath market movements. If you want to continue following analyses like this, you know where to find us. Because the most important thing is not what has already occurred, but the range of possibilities now opening ahead.